Back again in our studio, we have our finance expert, Mr. Colin Evans from Collins Financial. Colin, taxes are in, but that doesn't mean break necessarily. While some people may be receiving or have received their tax returns, others may owe money, and that's not helping outstanding debt that they may have, which is what we're talking about today,
right.
Debt. So tell us about the two different types that you're breaking down for us.
So we've got two different key types here, and the first one being revolving and the other one being non-revolving. And kind of illustrate that with the thought of a revolving door. And the revolving type debt is really one that can fluctuate. I think of that similar to a credit card or like a line of credit that you can get with the bank. It's, you can take money out, you can make a monthly payment that, it could be a minimum, it could be greater than a minimum. That's always something that can be fluctuating back and forth on what you pay and how you're paying that back, as well as like terms with the bank. The flexibility of that, though, gives a little bit more of an interest rate risk, and you have that typically the lender puts that back on to the consumer to have to bear that burden. So there is a risk there associated with that. And kind of if we've all kind of been there, used credit cards before in the past, we've all seen, just astronomical interest rates that are charged, especially if you withdraw money as like a cash advance or something along those lines. They really snag you on that one, and it's like it's almost, you have to almost fight to kind of get out of that. That can become a just burden monster on your back. When we go into the other version of non-revolving, that is more of like a fixed type of debt. And when we're starting to look at that, the simplest ways to kind of relate that are like a student loan, maybe a car payment, or even a mortgage. Those are typically set on like terms of how long and how much the payment is going to be over a certain period of time. So the lender has a little bit less risk on the table because they've got fixed period, fixed payments coming in. And I'll say a little bit of the nice thing about that for the consumer is you kind of already know. It's like, I know what my payment's going to be next month. I know what the the loan payment is, the mortgage payment, or the car payment, or those associated with it. And typically, because of that, we typically see a fixed interest rate involved in it, and it's not going to be one that can fluctuate or change or adjust on us on the dime. So, as we kind of frame those two together, they both have their place in in our workplace and our lives today. But it's kind of throws things along. And when we go back to the revolving type, one of the biggest things that can catch people is what occurred last year when we saw the inflation numbers skyrocket.
Right.
Well, and to offset that, our government was ratcheting up the Federal Reserve's loan rate to us. Well, anybody that had what they call adjustable rates, they were seeing their rates going up, almost every single month, which in turn caused the payments to go up.
Well, thank you so much for that explanation, and we'll see you next week. We appreciate your time. The FDA